How do you report fixed assets? Have you ever wondered how businesses keep track of their valuable assets? Today, we are going to talk about reporting fixed assets and why it matters for both accounting and tax purposes. Fixed assets, also known as property, plant, and equipment, are long-term tangible items that companies use to generate income. Getting this reporting right is essential for accurate financial statements and meeting tax obligations. First, when a business acquires a fixed asset, it is recorded on the balance sheet. The initial cost includes the purchase price and any additional expenses necessary to prepare the asset for use. This can include installation fees or delivery costs. This process is called capitalization. Once the asset is recorded, it is not expensed right away. Instead, the cost is spread out over the asset's useful life through a process known as depreciation. Depreciation allows businesses to allocate the cost of the asset over the time it is expected to benefit the company. There are several methods to calculate depreciation, and each method can affect financial and tax reporting differently. The straight-line method is the simplest, where the same amount is depreciated each year. Then, there are accelerated methods, like the double declining balance method, which allows for more depreciation in the early years. Another method is the units of production method, where depreciation is based on how much the asset is used. As depreciation is recorded, accumulated depreciation is tracked for each asset. This total is subtracted from the original cost of the asset to find its book value on the balance sheet. When tax season arrives, businesses must report their fixed assets accurately. This involves documenting the asset's cost, accumulated depreciation, and current book value. It is important to note that tax laws may permit different depreciation methods or rates compared to financial accounting. This can create temporary differences between book and tax values. If a fixed asset is sold or retired, businesses need to calculate any gain or loss. This is done by comparing the sale proceeds to the asset's book value. This gain or loss is reported on the income statement and, if necessary, on tax returns. Regular audits and revaluations are important to keep fixed asset records accurate. Adjustments may be needed if an asset's value decreases or if it is revalued according to accounting standards. In summary, reporting fixed assets involves recording their cost, tracking depreciation, and updating their value over time. This process is essential for accurate financial statements and tax filings, and it supports informed business decisions. Understanding fixed asset reporting is a key part of mastering accounting and tax practices.